very happy to have Bill Kitsch as our guest today. As a banker, Bill has a long history of working with food and farm businesses in our region to support our local food system. We've asked Bill to speak with us today about the unique role lenders can play in helping businesses survive crises. So thanks for joining us. Welcome, Bill. Would you like to start us off by sharing with our audience a bit of your professional background and a bit about Ephrata National Bank?
Sure. Thank you, Marilyn. Thanks for having me. My expertise in lending specifically as a banker is in the agricultural and food space. I've spent my career here in southeastern Pennsylvania. Prior to coming to Ephrata National Bank, I worked for the Farm Credit System, so directly with farm and agribusinesses there. Looking to expand a little bit of my scope and reach of services, I've joined a small community bank in Ephrata. So Ephrata National Bank is a billion-dollar bank. We're fairly small in the ecosystem of banking, but we're a community bank located in Lancaster, Pennsylvania. So again, from the food and agribusiness side, it's a really nice place to be, but where our reach goes as far as Philadelphia and west of Harrisburg and Adams County. So you kind of get a general idea of our footprint. The bank as a whole doesn't just specialize in agriculture. We also do C&I lending. We have a CRE portfolio. We have all those traditional services of a bank, including consumer lending. So we really say that we run on three rails here, and that is the consumer lending, the commercial lending, and the agricultural lending, and it's all about a third. I get to head up the agricultural side, so that's the perspective that I'll bring a lot of my insight from today.
Great. And I know we will be talking about your bank's role with the PPP program later as well.
We sure will. It's the hot topic.
Great. So let's start off with, from your perspective as a lender, how do you help your clients to build resiliency into their businesses during the good times to prepare them for uncertain times?
Yeah, and I'll jump off and just preference my comments in saying that, today bankers have really categorized themselves in one of two ways of their go-to-market strategy. And that go-to-market strategy could be transactional. And so we see a lot of conversation around the fintech companies and even how maybe a traditional borrower might interact with a broker to get a home loan. And then there's those of us that really bend towards the relational side. Myself, that's how I'm geared. So we get very involved in into that relationship with our borrowers. And, relationships isn't just a cliche. And although in the boom times, it kind of starts to feel that way a little bit, and lending and banking as an industry becomes a little more commoditized. We really fight very hard to maintain a high customization with our customers. And so what does that relationship look like? Well, just, put it in a nutshell, it's being conservative during the good times and courageous in the tough times. And so today with the pandemic, where it's at and the uncertainty of that pandemic ending or how long that tail looks like, we're really forcing ourselves as lenders and as bankers to be in that courageous environment. So what do we do to build resiliency is really talk about equity on a balance sheet. And so equity is a position of safety for a company or a small business. Leverage, on the other hand, is just the opposite. That's risk. If we all go back to those financial management courses we had in undergrad or graduate degrees, you'll know real quick that what it says is leverage up that balance sheet because that's how you maximize your return on equity. And although that is true, and I agree with it in theory, it's not always the best practice, right? In all things moderation. And so we really need to measure where we're at in our economic cycle and start building our strategy for the future. And so when we're in a strong cycle of increasing revenues and increasing profitability, we really ought to be taking some of that profit or a good portion of that net profit at the end of the day and putting it back to the balance sheet and deleveraging. Because we do know, just like our federal government has showed us here recently with the PPP loans, there's going to come a point where we have to dip into that rainy day fund, which we call equity, and distribute it out. And so you really need a lender that understands your business and understands that cycle in order to speak into it. And that lender if you really think about what lenders and bankers are, we're risk professionals. Every day of what we do on the inside of a bank is measure risk of your business. We measure that risk to assign appropriate rates to those loans. We measure those risks to assign specific conditions, and generally lenders do that from the perspective of protecting the bank. But I believe that in every good loan decision, there's a better business decision. And so not every good loan decision, I should say another way, which is in every good business decision, there's a loan to be made. Not in every decision a bank makes is it in the best interest of a customer or a business owner. Mm-hmm. And so in doing so, we really want to communicate out the risk analysis that we're doing on the inside of the bank and make it applicable to our customers and our clients. If you think about the position a lender plays, it is the glue that falls in between all the other professionals that you might utilize. Mm-hmm. And so whether it's your CPA or your attorney, there's no one professional that touches every bucket in your business like a lender does. Mm-hmm. And that's partly out of necessity. If you think about your total balance sheet, most of the companies we're working with are over 50% leveraged. And so if you have a company that has $1 million in net worth and they're 50% leveraged, we're equal partners, right? The bank has put in as much capital to that business as has the owner. And so there's a real level of risk there, but the return to the bank is a fixed rate of return. So the way that we work with that is we measure and control risk. We can use that in an adversarial contractual type of relationship, or we can use that to benefit the customer and the client through education and proactivity. And so that's what we do, Marilyn.
So it sounds much more like a partnership arrangement where your best interests align with the business's best interest at the end of the day.
And Marilyn, you know that I kind of cringe at the idea of being an advisor because there's a lot of regulations and things that prohibit us from taking a fiduciary role in a business. But if you come with inside banking, you'll hear a lot of buzzwords of becoming a trusted advisor and those sort of things. And probably like a lot of businesses that are on the call today, we have that same desire and hope as a relationship lender. But I do prefer the word partner because that's how you should be posturing yourself towards your lender or your banker, as well as the banker posturing themselves towards you.
So that's a great set of advice for when times are good and sort of preparing yourself, if you will. But what about when your business is in distress? What can your lender do to support you in that crisis? Yeah.
And I will say this is the third crisis that I've had the privilege of experiencing.
Only 3 in agriculture?
Well, we've had a lot of micro along the way, but large global, right? I was in the business in post 9/11, and so we had that crisis and the financial washout that followed that crisis, and then we also had the global crisis in 2008. And today we have the pandemic, and although there's similarities, there's also equal amount of differences. But there's lessons to be learned along the way, and that's where I build the conviction of really managing the time for crisis prior to the crisis. And so, but once we get there, assuming we have a strong relationship with our lender, we never want to get into a posture of contractual relationship. Once we get there, the train's kind of coming off the rail and we're spinning out of control. The minute I have to pull the note out and says, well, the note says you would do this, and I've got to force your hand, we're starting to degrade that relationship. And so the posture that we like to take is open and honest communication early in the crisis. And so as this pandemic started to come about, even before the shutdown was announced, we were encouraging our lenders to start making phone calls to borrowers and asking them specifically, rather than assuming, how is this going to affect your business? Have you thought about this? What sort of things can we change? And I'll give an example of one that I worked with directly. They're a greenhouse operation, a fairly sizable greenhouse operation they have a decent sized mortgage. They're not highly leveraged, but they have enough leverage in payments to create some risk and cash flow concerns. So early in the pandemic, we identified that because they work highly a large amount of their product is horticultural, and we saw that opportunity of Easter and then Mother's Day kind of walking away from them, we really saw that as a liquidity issue. And so we went to work saying, okay, what's our liquidity plan? We boiled it down to what the risk was in their specific business. And then we started to build a plan together. And we were able to lift their line of credit availability, although they have nothing on that line of credit drawn today. Or even when we did it, we just added some line of credit. We were able to defer some principal payments very early in the process, just to take that principal, and instead of sending it to the bank to repay their loan, just saying, we could put this on pause and put it in a safety fund. And we did that. So it's in a separate checking account, and it's kind of like a break the glass scenario. Mm-hmm. And then we also were able to engage them through a PPP loan. So if you look at that, we really used 3 different techniques, and over the course of those 3 techniques, we were able to add an additional $500,000 in equity, or not, I apologize, not equity, but $500,000 in liquidity to their operation. And, they've used about a third of that, and their sales have started to pick up. That actually allowed them to retool coming out of the horticultural season into a food crop season. So they were able to very quickly retool with that liquidity. And it's interesting because in 2008, it was really a revenue crisis. The sales just disintegrated off the top line, and it went away. And really no amount of liquidity was really going to save our problem there, because the consumer went away from our businesses. But today we have an event that we don't know how long it's going to last. It's kind of the consumer is gone artificially. But when this event ends, it's how quickly can I get back up and going to capture that market share and capture that consumer again. And that really becomes liquidity. And I've got this saying I tell my clients all the time, which is, sales is the gas in the engine. Your business is the engine itself, but liquidity is the oil. And without liquidity, it doesn't matter how much gas you put to that engine, you're just going to do damage. And so we recognize very early that this pandemic is a liquidity crisis, and we've taken the posture of doing everything we can to build liquidity. So there are just a couple of ideas that we've executed in this pandemic, but there's all sorts of tools like that if you can identify the risk early and communicate it clearly. What I would encourage business owners not to do is to kind of hide and try to make their business look better than it is. Be open and honest and share the risk. And we often will ask our clients, regardless of the situation, what's your worst case scenario, what's your most likely, and what's your best case scenario?
So that is a wonderful setup to our last question, which we have about 2 minutes to answer. So I'll give you the 2-minute warning. Clearly, as a banker, you're familiar with the toolkit that's available to you. But often as borrowers, we might not have that level of sophistication. So as a borrower, what can you ask your lender to do to help you rethink and reinvent your business as you emerge from this pandemic?
Yeah, so, and again, in farming, one of my passions in farming is that I often tell everyone, part of what I love to do is put the entrepreneur back on the farm. And you think about it, and everybody might say, what do you mean, Bill? Aren't they all entrepreneurs? They are all small business owners, but farmers today, in the way farming is, we've kind of lost through generational transfer some of the entrepreneurship that we would have seen back in the 70s when my grandparents would have been farming. Today, post this pandemic, you're all in that same kind of spot, which is you have to put your entrepreneurial hat back on and say, once they open the doors, if my business is shut down, whether I'm a restaurant or a video game store, we have a local video game store that's a one-off store. They do a great job with all the teenagers in the neighborhood. And they're shut down, right? So their sales are greatly impaired. They're maintaining some sales now to keep afloat, but how do they get that clientele back in the door, and what sort of events do they execute? And so what I've encouraged every customer that I come in contact with is start building that post-pandemic business plan, right? And then once you have that business plan, call your lender and ask to make a presentation. One of the greatest lessons I ever learned was from an old gentleman. He was in his 90s when I was a young lender, and he came in one day to my to my office, and I had just inherited his account from a retiring relationship manager. And Mort came into my office, and he had this big, long yellow pad. And he said to me, "We need to talk about what next year looks like." And I'm thinking, what do you mean? Your business is golden. You're one of our marquee accounts. We love you. And he sat down with me with a pen and paper, and he had it all written out. And that entire yellow pad was full of what could happen, what will happen, what are his plans, his hopes, his dreams, what's he want to execute. And by the time we were done with that conversation, it's not that we reworked his entire capital structure, but we tweaked it a little bit. I was able to say, well, if you're going to do that, maybe we could do this. And we just tweaked. And, a small amount of effort generally gives you the greatest amount of relief or opportunity.
Right.
And we find that in sales every day, right? It's the last sale in the door where your fixed expenses have been paid for that you really get to capitalize and makes up 80% of your yearly profit. And so if you think about that in terms of capitalization or liquidity, it's that last little tweak to the model or to the capital structure that will help you. And so, what you should be doing today is contacting your lender, whether you think you need them or not, and have a conversation. And one of the greatest things about this pandemic, if we can say that, is that it's forced us old stodgy lenders to get out of our comfort zone. And we use things like this and video calls, and we can share screens, and we can do things much more efficiently, where a 4-hour appointment of me driving to your location and sitting down and everybody wearing jackets and ties and we get about 45 minutes of real talk has now turned into, I can get you on a video call and we do an hour and a half of real number crunching. And because I have my computer in front of me and I've got access, and we can have those deep conversations. So there are limitations that a lender has between regulatory, what the regulator allows us to do and what you may want them to do. Your lender should be open and honest with that, but a creative lender will find ways to get done what you need to do if you can communicate clearly what your business plans are and what you're driving toward.
Great. I'm going to stop you there. We are about to go to our unrecorded session for Q&A, but first let me invite everyone who's on the call today to join us next week on Thursday, May 14th, when we'll be talking with Andrew Nakich. Andrew is the co-founder and CEO of Habitat Logistics. It's a last mile delivery for local businesses. And Andrew will be talking specifically about the pandemic's effects on retail and restaurant industry in our region. So be sure to join us for that at 3.